As parents, we all have dreams for our children. We want them to study in a good school, pursue the career they are passionate about, and never have to compromise on their education because of money. But the question is, once your child turns 18 years, how much do you think a college education will cost? Will 20 lakh be enough? 50 lakh? Or will you need more than 1 crore? The reality is that education cost has been rising at a faster rate. A course that costs 20 lakh today may easily cost 40-50 lakh after 15 years. And if your child wants to study abroad, the number can be significantly higher. That's where the question is, how to invest for child's education? What are the investment options? How much SIP is actually required? Should you open a minor account or invest in your own name? These are exactly the questions we'll answer in today's video. By the end of this video, you'll have a clear step-by-step framework to build an education corpus for your child. From calculating the target amount to choosing the right investments and avoiding some of the biggest mistakes that parents make. Alright, let's get started. To begin with, the first question you need to answer is, how much money will you actually need for your child's education? Because if you don't know the destination, it's impossible to plan the journey. Let's assume your child is 5-year-old today. That means you have roughly 13 years before they go to college. Now think about the cost of higher education today. A good engineering degree from a private college can easily cost 20-30 lakh rupee. A medical degree can cost significantly more. And if your child dreams of pursuing higher education abroad, the cost could easily run into 1 to 2 crore. But the challenge is, these are today's cost. Education inflation has historically been higher than normal inflation. While general inflation is around 5 to 6% in India, education inflation is around 6 to 8%. For example, if a course costs 20 lakh today, assuming education inflation of 6 to 8%, the same course would cost around 45 to 50 lakh after 13 years. If your child is a newborn and you have 18-year horizon, the cost could rise 60 to 70 lakh rupee. And what if your child wants to study abroad? In that case, you're not just dealing with education inflation alone. You also have to account for currency risk. So let's say a university in US charges 50,000 USD per year today. Even if the tuition cost itself does not increase significantly, if Indian rupee continue to depreciate against US dollar over the next 15-18 years, you'll end up paying much more in rupee term. The same applies to countries like UK, where pound to INR increase can further increase the overall cost for Indian family. That's why if you're planning for your child's education abroad, it's better to build some additional margin into your target corpus. So the first step is clear. Estimate the education cost based on your child's aspiration, factor in inflation, and if you're considering overseas education, don't forget the impact of currency movement. Once you know your target corpus, the next question is, how do you actually build it? Let's have a look. So when it comes to child education planning, there's no single investment plug that is perfect for everyone. You need a right asset allocation strategy. And it depends on two things. How many years are left before your child starts college and how much risk you are willing to take. For example, if you ask me, if your child is very young, let's say 0 to 5 years, and you have a long-term investment horizon of 13 to 18 years, here your biggest advantage is time. And historically, equity has been one of the best asset class for creating long-term wealth. While short-term market movement can be unpredictable, a longer investment horizon gives compounding enough time to work in your favor. So if you ask me, you can consider, let's say, 80% exposure in equity and 20% in debt or fixed income instrument. This allocation can be kept till your child reaches, let's say, 13 years of age. Okay, just hold on to this. We'll discuss investment option in the next category. How do you invest in equity mutual fund? Now, when your child age is between 13 to 16 and your corpus has become decent after years of investment, you need to balance your portfolio to protect your gain. For example, you can gradually shift from 80% equity to 50% equity and remaining 50% in debt or fixed income instrument. And finally, when your child reaches, let's say, 16 years of age and when there are only a couple of years left for college, you need to shift entirely to liquid, ultra-safe income asset, like 90% in safe instrument and 10% in equity. Because if market falls 25-30% just before a few months from your child admission, you would be forced to withdraw at worst possible time. That's why your investment strategy should evolve as your child grows older. This gradual shift in asset allocation is known as glide path. an aggressive allocation during early year, a balanced approach as the goal comes closer, and a conservative allocation near the finish line. One more point, asset allocation is not a one-time exercise. You should review your portfolio at least once a year and rebalance it whenever required, so that your investment continue to remain aligned with your long-term goal. Now that we have a broad asset allocation framework in place, let's look at different investment options available and understand where each one fits into the plan. Now the next question is, where should you actually invest? Here, one mistake I would suggest please avoid is buying those traditional child insurance plan or ULIPs simply because they are marketed as education planning solution. In most cases, these products lock your money for a long period, have very high charges, and historically they have delivered poor return as compared to a well-constructed equity mutual fund portfolio. So I always prefer keeping insurance and investment separate. Buy a pure term insurance plan to protect your family and build your child education corpus through investment. Now let's first build the growth engine of your portfolio. So if your child is still 13 to 18 years away from college, equity mutual fund should ideally form the majority of your portfolio. Here a lot of people make the mistake of considering 15 to 16% annual return. I think that's an over expectation. You need to be practical. In my opinion, a fair expectation of return would be 11 to 12% CAGR rate. Of course, the actual return could be slightly higher or lower depending on market condition. But don't project very high return. Keep your expectations realistic. Here you might ask, what about individual stocks? So while individual stock investing can be very rewarding, and in fact I myself do it, the problem is many people try their luck in stock market without any knowledge and they simply buy stocks based on tips. That is not sustainable. Stock investing is not easy. First of all, you need to spend a few years trying to understand the market cycle, business cycle, and economic cycle. Then you need to spend time on research. Learn about the business, its key strength, future prospect, key risk, and whether the company is available at right price or not. That's not easy. All this requires a good few years. You can't learn this overnight. And the fact is, if you have a job or business, it's very tedious task. On top of that, you need to control your emotion of fear and greed. You need to have patience and discipline. Although I do teach all these things in my exclusive weekly series, my honest opinion is to have minimum exposure in individual stock until you learn the art of stock investing. And only when you're confident, then increase exposure in individual stock. And if you don't want to take so much of a headache, better stick with a mutual fund. Now within equity mutual fund, rather than investing everything into a single fund, try to diversify across category. For example, out of 80% investment, you can have 30% into Nifty 50 index fund. This forms the foundation of portfolio. It provides exposure to India's largest business, generally with relatively lower volatility than mid and small cap. Or you can also consider Nifty Bs. It's an ETF. Then 30% allocation can be towards flexi cap or multi cap fund. This is your diversified growth bucket. A flexi cap fund gives fund manager the flexibility to allocate across market cap, while a multi cap fund maintains mandatory exposure to large, mid and small cap company. And remaining 20% can be allocated towards mid or small cap fund. This is high growth portion of the portfolio. These companies have the potential to deliver superior long-term return, but they also comes with higher volatility. And the problem is, very few people actually have the appetite to take that kind of volatility. That's why I would not allocate majority of my portfolio here. Of course, every person is different and you're free to decide how much allocation you want in which category. But this is an ideal suggestion I've given. Now an equally important question is, how do you choose the right mutual fund? Here please don't make the mistake of selecting a mutual fund simply because it has delivered the highest return over the last 1 year. This is the biggest mistake people make. And I've said this multiple times in the past. Past performance does not guarantee future return. So you need to evaluate how the fund manager invests, whether the investment style has remained consistent over time or not, how the fund has performed during both bull market and bear market, and whether it has generated superior risk-adjusted returns or not. To understand risk-adjusted return, you can look at metrics like Sharpe ratio, Sortino ratio, and beta. That will provide you an insight on volatility and risk-adjusted return. And you can Google it. In fact, I've done a video, we can watch that as well. Now, the remaining 20% of the portfolio should ideally act as a stabilizing anchor. If you have a daughter, Sukanya Samriddhi Yojana is worth considering. It is backed by Government of India and currently it offers one of the highest interest rate among your small savings scheme, and the interest as well as maturity proceed are tax-free under EEE structure. If you have son, Public Provident Fund can play a similar role. It was also government-backed, enjoy EEE tax treatment and provide a stable foundation to overall portfolio. Here please note that the objective of this 20% allocation is not to maximize return. Its role is to provide stability, reduce overall portfolio volatility and create a cushion that can gradually be increased as your child gets closer to college. Now some of you may be wondering whether gold should also be a part of your child's education portfolio or not. So I would say that gold can be considered for marriage purpose. Gold is an excellent diversifier, but I don't see it as a primary wealth creation engine for long-term goal like higher education. But in India, gold has cultural importance, especially when you have a girl, you want to accumulate gold for her marriage. So in that case, you can consider allocating 5 to 10% of your portfolio to either buy physical gold or electronic format like gold ETF or gold mutual fund. Just to summarize, think of your portfolio as an engine. Equity does the wealth creation part, whereas your debt or fixed income protects the wealth that you have created and gold acts as a hedging instrument. And as discussed, keep reviewing your portfolio every year. And once your child reaches say 13 years of age, start rebalancing your portfolio towards 50% equity and 50% safer instrument till 16 years of age in a systematic manner. And finally, towards the last couple of years, systematically rebalance your portfolio with 90% safer option to avoid equity volatility impacting your corpus. Now the next question is to identify how much money you need to invest to achieve your child's education goal. Let's discuss it. Now comes the most important question. How much should you invest every month? Well, unfortunately, there is no one-size-fits-all answer because every family goal is different. Some parents may want to build a corpus of 30 lakh, while others may be planning for 1 crore or even more, especially if they are considering overseas education. So let's understand this with a few examples. Suppose your child is 5-year-old today and you have a 13-year investment horizon. If your target corpus is 25 lakh and you assume a blended 10% annual return for planning purpose, your monthly SIP works out to be roughly around 8,000 rupees. If your target corpus is 50 lakh, the required SIP increases to approximately 16,000 per month. And if you're planning for 1 crore corpus, you'll need to invest around 32,000 every month. You can get these calculator on internet. Now you might look at these numbers and think 32,000 per month is impossible for me. But here is the mistake you are making. You are assuming you'll invest the same SIP amount for next 13 to 18 years. But as your salary or business income grows, your investment should also grow. And that's where step-up SIP becomes extremely powerful. So instead of investing 32,000 every month for next 13 years, imagine you start with 20,000 and simply increase your SIP by 10% every year. Then also you can achieve the corpus of 1 crore. So don't get discouraged if the required SIP looks too high today. Start with an amount you are comfortable with. Commit to it, increasing it every year, and let time and compounding do the heavy lifting. Now, once your investment engine is running, the next important question is something that confuses many parents. Should you invest in your own name or should you open a mutual fund account in your child's name? Let's discuss it. So you can definitely open a mutual fund account even if your child is a minor on their behalf. There are many platforms like Zerodha Coin that allow minor account opening. Even individual AMCs allows it. In this case, you as a parent will manage the investment until your child turns 18. Once your child becomes an adult, the account can be transferred to their name after completing the required KYC and other formality. Now, many parents think that if they invest in their child's name, they'll immediately start saving tax. That's not how it works. Till your child turns 18, the tax benefit does not automatically shift to the child. Your tax would be considered on your PAN card. So opening a minor account does not give you an immediate tax advantage. However, things change once your child becomes an adult and investments are transferred to their name. From that point onward, your child becomes a separate taxpayer. Let me explain this with a simple example. So as per today's tax rule, long-term capital gains from equity mutual fund up to 1.25 lakh in a financial year are completely tax-free. Let's say you have mutual fund in your own name and your child also has mutual fund in their own name after turning 18. Now, if you book 1.25 lakh of long-term capital gain in a financial year, You won't pay any tax on those gains. Similarly, if your child also booked 1.25 lakh of long-term capital gain in the same year, he also won't have to pay any tax. So together, your family has realized 2.5 lakh of tax-free long-term capital gain under today's tax rule. That gives you an additional layer of tax planning. But remember, we are planning for a goal that is 15-18 years away. Tax rule can change many times over such a long period. By the way, there's another option that many parents don't know about. Even if you have been investing in your own name, you can later gift your mutual fund units to your child. So you don't necessarily have to start with a minor account from day one. This gives you flexibility while planning your family's wealth. So practically, you have three choices. First, you can invest in your own name and use that corpus for your child education. Second, you can open a minor mutual fund account right from the beginning and let the ownership shift to your child after they turn 18. And third is, you can invest in your own name today and give the mutual fund unit to your child later. Personally, I don't think this decision should be driven only by tax saving. The biggest objective is to create a dedicated education corpus that remains untouched for the next 15-18 years. Whether that corpus is built in your name or your child's name is secondary. Starting early, investing consistently, and staying disciplined will make a much bigger difference to your child's future. Okay, let's quickly recap what we have discussed today. The first step is to estimate how much your child's education is likely to cost after factoring in education inflation. Once you have a target corpus, decide the right asset allocation based on the number of years left until your child starts college. Build your portfolio using right mix of equity, debt or fixed income instrument, and if required, a small allocation in gold. Now calculate the SIP required to reach your goal, and if possible, increase it every year through step-up SIP. Finally, decide whether you want to invest in your own name or through a minor account based on what works best for your family's financial planning. But before I end this video, there's one thing that is even more important than your investment. Please don't ignore term insurance. If you are the primary earning member of your family, your child education plan depends on your income. If something unfortunate were to happen to you, a well-planned investment portfolio alone may not be enough. And that's where a pure term insurance policy ensures that your family financial goal, including your child education, can still be achieved even in your absence. That's why I always believe insurance and investment should have separate roles. Insurance protect your family while investment help you create wealth. And finally, remember this. The biggest advantage you have today is time. You don't need to predict the next multi-bagger stock or perfectly time the market. You simply need to start early, invest consistently, and allow compounding to do its job. Even if your child is just a few months old today, the decision you make over the next few years can determine the opportunities they have 15 or 18 years from now. So don't wait for the perfect salary, the perfect market, or the perfect time. Start with what you can afford today. Review your plan every year, increase your SIP as your income grows, and let time become your biggest wealth creator. So if you find this video helpful, do share it with other parents who are planning for their child's future. It might help them avoid costly financial mistakes and start their journey much earlier. And if you have any doubt, let me know in the comments. I'll see you in the next video. Till then, take care.